Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're diving into the end of Q3 earnings season. So this is one of the last big weeks for Q3 earnings season, and we're going to take a look at two of the biggest names left to report, and that's Target and Nvidia, to see if investors maybe should consider buying either of the stocks before earnings. But before we get into everything, I want to say to remember to subscribe and leave a review wherever you listen to your podcast. And make sure to check out our new Zacks.com/promo page for a look in some of our services, portfolios, and more. All right, so we're going to quickly just do a little bit of a market overview before we dive into Target and Nvidia. So if most of you are paying attention, we know that stocks soared to record highs last Monday as Wall Street celebrated Pfizer's big COVID-19 vaccine announcement. Prior to that, the market had ripped higher after the election, as investors apparently were pleased enough with the likelihood of divided government in Washington. And then on Monday, today, Moderna said that its experimental coronavirus vaccine was 95% effective at protecting people from COVID-19. So more good vaccine news. We'll see what happens with all of that. Investors should note that analysts at Goldman Sachs and other major Wall Street firms such as JP Morgan have sent out bullish notes since that Pfizer announcement last week, telling their clients that they see the market climbing big in 2021 and 2022 if there is a vaccine at some point rolled out next year. And it's not just the prospect of a vaccine that has people a little more bullish. The earnings picture continues to look strong. So the S&P 500 earnings are projected to surge in 2021. And the Q3 earnings results continue to come in stronger than expected. And we have the Q4 estimates looking better and better. So I'm going to quickly just look at the numbers we have, our most recent Zacks estimates for these overall S&P 500 earnings. Our current estimates at Zacks are calling for Q3 2020, so this quarter that we're reporting right now, the earnings to fall 8.6% on 1.2% lower revenues. This would mark a huge improvement from the second quarter when we saw revenues slip 9.3% and earnings fall over 32%. And then if we look ahead to Q4, we're trending once again in the right direction. And then if we look at the overall year for 2020, we're calling for earnings to slip about 17.4% on 4.2% lower revenues. And then if we look ahead to fiscal 2021, we're calling for a big jump back. So 22% earnings growth on 7.7% higher revenue. So the earnings trends are trending heavily in the right direction, which is a bullish signal for sure for the market. So with that out of the way, and just a broader look at the earnings season, we're going to take a look at Target and Nvidia. And we're going to start with Target, which trades under the ticker TGT. It's set to release its Q3 financial results before the opening bell on Wednesday, November 18th. So this upcoming Wednesday morning. So Jeff Bezos and Amazon have slowly steamrolled many of these traditional retailers and small businesses, but the other big players planned and invested in the future and are more than ready to compete against that Seattle giant. And in fact, if we look at Target, the stock has outpaced Amazon over the last several years. So we're going to dive into what's going on at Target and then take a look ahead before we decide if it might be worth buying. So Target's expanding portfolio of same-day e-commerce offerings includes in-store pickup, drive up, its subscription style ship it unit. Basically, they're just giving people as many options as possible to buy online, pick up in stores, have it delivered. It's generic at this point, but it's very important. So these various options are proving vital during this coronavirus economy and will be more integral going forward for years and years to come. So for reference, Target's Q1 sales jumped about 11%, with its Q2 revenues up 25%. We saw its comps climb by a record 24% last quarter. So second quarter was a huge quarter. Digital comps are up almost 200%. Same day services were up 275%. You get the gist. It was a really big blowout quarter in the second quarter for Target. Despite all of this e-commerce growth, it's really worth noting that the retailer posted one of its strongest quarters of in-store comparable sales growth, up roughly 11% of in-store growth. So its ability to grow both in stores and e-commerce is going to prove vital going forward because brick and mortar is not dead. Some brick and mortar is dead, but it's alive and well at these big box retailers like Target and Walmart, Costco. So for instance, e-commerce accounted for 16% of total U.S. retail sales in the second quarter. up from 11% in the year ago period. And that's a big number. That's a big jump. But some people might have expected that figure to be higher in general, given the near perfect conditions for e-commerce to shine during the second quarter. So it still only accounted for 16% of total U.S. retail sales in that quarter. So obviously, miles of room to grow for e-commerce. And Target is able to grow both brick and mortar and e-commerce. So unlike Amazon, who has a very, very small brick and mortar retail footprint. So we're going to take a look at some other fundamentals. Target's ability to cultivate this strong brand presence and continue to attract younger customers bodes well. And it stands in pretty stark contrast to the likes of Macy's and some of the other traditional department stores, which also report this week, that have really suffered hugely in this changing retail environment. The company has multiple lines of what people would say are trendy yet affordable furniture, home decor, fashion, and more. And as we just mentioned, as foot traffic fades in these department stores and malls around the US, it's worth noting that brands such as Levi's are turning to Target for that exposure. So that could be a trend to watch, that some of these brands are, why invest in a store like Macy's when fewer and fewer people are shopping there? Meanwhile, its flagship grocery brand, which is Good and Gather, has built strong momentum after it rolled out last September. And then obviously the company is also exposed to the consumer electronics market, though not as much as a player like Best Buy. So overall, Target stock is up about 50% in the last year. This easily tops Walmart's 27% climb. And if we look back for the last 3 years, Target is up 185%. And this actually tops Amazon's 175% and blows out Walmart's 60% climb over the stretch. And despite its outperformance, Target trades at a discount compared to both. Target's currently trading at 21 times forward 12-month earnings versus Walmart's 26.4, and Amazon, in terms of forward earnings, is trading at 72 times. So obviously, Amazon's a different company than Target, but Target's trading a discount compared to Walmart and Amazon, even though it's outpaced both of those companies over the last 3 years. We should also note that its operating margin comes in well above those peers as well, and it climbed to 10% last quarter, up from 7% in the year ago period. You should also note that Target raised its dividend over the summer, and its yield of 1.67% tops Walmart at the moment and roughly matches the 30-year U.S. Treasury. Target also currently holds B grades for value and growth in our style score system. Now we're going to look ahead at some estimates. So for its soon-to-be reported Q3 results, we're calling for its earnings to jump over 16% on about 11.5% stronger sales. This would mark a bit of a slowdown, obviously, compared to that blowout second quarter, but it would match Q1 and still mark strong improvement compared to pre-virus periods. So if we peek further ahead, its fourth quarter sales are projected to pop over 6%, which would stack up well against many of Target's pre-pandemic quarters over the last several years. So that 6.4% in Q4 would stack up really well against some of its best quarters before the virus hit. Overall, its adjusted fiscal 2020 earnings are projected to climb over 13% on 13% stronger revenue, and its strong bottom line revisions help it land a Zacks rank at number 2 buy at the moment heading into its Q3 release. We should also note that the company has crushed our bottom line estimates recently. It topped our estimate by over 100% last quarter as part of a longer stretch of beats. And it's also worth noting that the stock has recently traded pretty heavily around earnings. In 2 out of the last 4 quarters, it moved pretty significantly after it was really able to impress Wall Street. So it actually, I'm looking at right now, in 4 out of the last 6 quarters, it's climbed by roughly over 10% on some really positive news. So that's worth noting. If you're trying to play it around earnings, you could see a big jump if it's able to continue to impress Wall Street and investors. That might be a little hard as the stock is trading relatively near its highs, and there could be some selling pressure if people want to take home profits. That said, longer-term investors certainly might want to consider Target, as it's going to be a major player in this retail space. Big retailers are only growing as they force out some of these smaller mom and pop shops around the country. and e-commerce is only becoming more popular. And Target, unlike some of these other companies that might be banking on a vaccine, it really doesn't need help on the vaccine front in any way. Target looks like it's ready to keep on rolling, and we should note that it jumped about 1.5% through morning trading on Monday, heading into that release on Wednesday morning. And now we're going to move on to a totally different stock, but it's another huge name that's set to report, and that is Nvidia. The company trades under the ticker NVDA, and it is set to report its Q3 fiscal 2021 results. It's on a different fiscal calendar, but it's reporting its Q3 results after the market closes on Wednesday, November 18th. So after the closing bell this upcoming Wednesday. We're just going to dive right in. So Nvidia rose to prominence as a GPU firm that mostly served the booming global video gaming space. And this market alone is massive, with reports projecting that it could climb by over 9% this year to reach about $160 billion in 2020. And it's expected that global market is projected to surpass $200 billion by 2023. So this market alone, hugely addressable market that's certainly going to help Nvidia for years. But Wall Street has grown far more excited over the last several years as the company has expanded its reach into data centers, cloud computing, artificial intelligence, and other areas of future growth for tech. So for instance, last quarter, Nvidia's revenue soared about 70%, with its data center unit up about 170%. To account for about 45% of total sales. So almost half its business was coming from that data center unit. The company has invested heavily in this, and that's where they see a lot of their growth coming forward in that data center cloud computing space, which is in a world where there's so much data. This is going to be a big business for them going forward. Nvidia has also set up itself for greater success in a world where we see the likes of Microsoft and Amazon transforming their companies through this cloud leadership. So the company is also ready to expand through acquisitions. The company purchased Mellanox Technologies for roughly $7 billion in April. That's when the deal officially closed. And it was its largest at the time. Then things changed relatively quickly. So in September, the company made a pretty big splash on Wall Street when it announced that it would acquire ARM, which is owned by SoftBank, for $40 billion, mostly in stock. So the company is able to benefit from its rising stock price, that companies are willing to take its stock as payment. So for those of you who don't know, ARM is one of the most important behind-the-scenes companies in the chip space. It designs and licenses basic blueprints of chips that consume the least amount of energy. Its blueprints are used in roughly 90% of the world's smartphones. However, this big deal, which would be the biggest in history, does certainly face some tough regulatory approval measures that it has to go through the US, China, and the UK. So there's no guarantee that this will happen. And no matter what, it's going to take a long time. I've read different opinions about if this will go through or not. So there's no guarantee. It's certainly a big bet that Nvidia is making that it will go through, and if it does, it sets them up even more for what would be pretty dominant position in this market for years and years to come. And it's hoping it can play a big role in this what people continue to say is a future of AI and cloud computing and all of those other buzzwords that are in fact becoming real things. But even if the deal doesn't go through, Nvidia's outlook still appears really solid. Zacks estimates are calling for the company's adjusted Q3 earnings to climb over 44% to hit $2.57 per share on 47% stronger revenue. That would see it climb to about $4.4 billion. If we look ahead to Q4, we're projecting another 44% revenue growth, with its earnings projected to climb 36%. And if we look at the entire year, we're calling for its revenue to climb 45% and then jump another 18% the year after that. So some stable top line growth going forward, especially in a historically cyclical industry, is always a good sign. And then over this same stretch, we're calling for its adjusted earnings to climb about 60% this year and then another 21% next year. We should also note that the company boasts some strong earnings revision trends, and it's topped our bottom line estimates by an average of about 12% over the trailing 4 periods. And the company is currently a Zacks ranked number 2 buy, just like Target, heading into its Q3 earnings release. The stock has soared about 120% in 2020, and this is against its industry's 30% climb. This is part of a much more impressive run over the last 5 years. The company does also pay a dividend. Its yield is obviously very low at the moment, considering just how far it's climbed. We should also note that despite this impressive run, the stock is currently trading about 8% off its recent highs as of early afternoon trading on Monday, which could give it some more room to run if it's able to impress investors in Wall Street on Wednesday. With this in mind, its valuation is a tad bit stretched, but investors have been willing to pay a premium for Nvidia for years. And obviously, playing a stock just around near-term earnings-based gains is a riskier play, but longer-term investors don't need to try to time the market as much. So if you are at all bullish on Nvidia over the longer haul, year plus out, it's certainly never a bad time to consider buying it, even though maybe there could be some more selling pressure if it's unable to, quote unquote, impress Wall Street in the near term with its results. But you never know. And the last 2 weeks has showed that it's always better if you can afford it to stay as exposed to the market as possible, because if not, you can miss out on some of these huge swings. So if you were out of the market worried that the election was going to cause all of this turmoil, you missed a huge rip up back to new highs. So that's certainly worth remembering when you're thinking about buying stocks, especially if you have a longer term investment horizon. So that does it for another episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.